Good afternoon, everyone. It is Tuesday. It's time for That's Our Two Satoshis Live. I am joined by Nick Hotes, who's been a frequent guest on the show and a loyal contributor to That's Our Two Satoshis, as well as just a pretty good all around guy. Nicky, how are you today, sir?
Doing well, Jeff.
Good, good, good. As everyone knows, it's That's Our Two Satoshis. It's not That's My Two Satoshis. We get a lot of contributions from the ARCA team here. And Nick wrote a good piece this week on our blog at ar.ca/blog, which you can read. As always, we've been doing this for about 5 years. We write about the digital assets market. We talk about it. Got a lot of different resources on our website available, as well as now through podcasts and YouTube and some other mediums. Basically, just love talking about the digital assets market, what's driving prices, what the big story of the week is. And as I said, Nikki jumped in here this week in my absence and wrote a pretty good piece talking about what's really happening from a macroeconomic standpoint and how that is um, driving Bitcoin prices, as well as getting into Arbitrum and some other aspects of helicopter money that's coming around. But as always, before we get started, let me read you a quick disclaimer. This commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstance. So, Nick, a couple weeks ago, I wrote all about what was going on with the lack of trust in banking, the lack of trust in government, and how that was driving assets into brokerage accounts, treasuries, as well as into Bitcoin and ETH. What are you seeing after another week of failures at the banking level, this time over in Europe with Credit Suisse, and once again, central banks stepping up again to backstop the banking industry?
Yeah, I mean, it feels like the first time where macro's kind of been on our side to some extent. I mean, it's really been the story of the week in macro was interest rates, and really just the complete pivot in expectations for what the Fed is going to be doing and what central banks broadly are going to be doing over the next few months. You essentially went from like expecting 50 basis points in hikes and then kind of maintaining it where it is, even a couple more hikes after that, going forward into the year, to now just pricing incredible cuts, 100 basis points plus over the next year plus. And really, if you look at like euro dollars, for example, which I didn't really write about, a lot of those are priced in right in the next 3 to 6 months. So the market is kind of pricing a credit event in the next, very, very near term.
And
Um,
this happened incredibly quickly. I mean, we're talking about what,
yeah,
12 days ago, Powell spoke and was incredibly hawkish, talking about higher rates for longer. And what, a day or two after his speech was when we had the first, you had, I guess Silvergate went down first, then it was Silicon Valley Bank, then Signature Bank, then the problems with First Republic and Credit Suisse. I mean, so this was, not only are we talking about a huge move in rates, but in an incredibly fast period of time.
yeah, and I think a lot of that is driven, as you said, Silvergate and Signature were really kind of kicking that off. But then the ongoing failure of Credit Suisse, I think it was really what escalated things a lot, because those other banks, they're regional banks. They represent kind of the problems in the financial system just related to how much tightening has happened over the last year or so. But Credit Suisse is a systemically important bank. If Credit Suisse goes down, loses depositors, that's a very, very big financial problem. So I think having that continue to be an issue throughout the week was really what was getting the market a lot more build up on interest rates and seeing more friendliness from policymakers going forward here.
Yeah, and obviously the irony, of course, is that rising interest rates is what caused a lot of the problems on banks' balance sheets, and now, of course, because of the banks' problems, we're seeing a big rally in treasuries. So the irony is not lost here. So, what do you think that means with regard to what Powell is going to say tomorrow at the March FOMC meeting? I think right now, as we're talking right now, there's about an 80% chance of a 25 basis point hike, in line with what expectations were before all of this um, banking crisis and before the market started to price in 50 bips. What do you think he's going to do tomorrow? What do you think he's going to say? And what are you seeing with regard to, quote unquote helicopter money and support going forward here for the economy?
Yeah, and I think you and I might disagree a little bit here, but it'd be good to get into it a bit. I do think that Powell has to kind of try to maintain his credibility still, and the credibility that the Fed has built up really in the last year or so of actually keeping policy tight as the economy slows. I think they'll probably do 25, but I do think that they're going to push back a lot on what the market has done in the last couple of days here and really reemphasize how much they want to hold rates where they are until inflation comes down.
So I agree with you on that for sure. I think 25 basis points is right down the middle, right? I think if they go 50 bips, it's way too much given, the fallout of the last 2 weeks. I think if they pause completely, it's going to be viewed way too bullish, which is not what they want. I think 25 bips is the answer. I also agree with you that Powell is going to probably try to talk down the markets with the expectations that there's going to be rate cuts really quickly. I think the problem is I think there's no chance that he can regain credibility. I mean, again, he spoke 2 days before a banking crisis about being tougher for longer, had no indication that banks were failing, that this was going to happen. I think the Fed's credibility is gone. I think it's been gone for a while. And I think it's going to be virtually impossible for Powell or anyone at the Fed to get that back. I do think they're going to try. I don't think the market's going to believe it or care. And I think that's going to be interesting, right? Because I've been shouting, from my soapbox for a year now that macro has not been the driver of digital asset prices, right? Going back to June of last year with Terra Luna in May, and then Three Arrows, and then on the positive side, the Ethereum merge, and then on the negative side, FTX imploding. I think the idiosyncratic events of digital assets have mattered much more than macro. Macro still matters. It's just not driving the bus anymore up until 2 weeks ago. And because of the events of the last 2 weeks, I think macro is 100% driving the bus right now. I think this flood of support from governments around the world is the same bullish undertone as we saw in 2011 when you had global coordinated central bank support. I think this is a risk-on rally for equities. I think it's a risk-on rally for digital assets. And I don't think there's anything the Fed can do to stop that right now. Agree or disagree?
I think the Fed is, I don't think there's anything they can do to stop it. I do think that, they really need to, what they were trying to do here is keep banks lending to each other, right? Like if banks stop lending and the credit markets freeze up, that will tank real growth. And the soft landing that's been being priced in, that just goes by the wayside. So I think what they're doing here is not like trying to like really stimulate the economy and bolster real growth. They're just trying to shore up the financial system long enough to kind of get past this tightening that's already baked in. There's a real growth contraction that I think is still ahead of us, and that the market still probably needs to react to because the economy is still slowing.
But that was happening. But that was happening long before. I mean, again, we're talking a very short time horizon, right? It's been less than 2 weeks since these banks started to have trouble, or at least visible trouble. But to your point about making sure credit is flowing, which is very important for the economy, credit stopped flowing 6 to 9 months ago. I mean, you've already seen a massive contraction of lending, right? There's a reason why banks have not increased interest being paid out, because they don't care about attracting more depositors because they have nowhere to go with the money. They're pouring it into reverse repo facilities back at the Fed because they have nowhere to lend, right? An inverted curve. We've seen 2s 10s and 2s 30s inverted now for almost a year. You don't lend in that environment. If you're borrowing short and lending long, you're just not doing that. So I understand what you're saying, that this is not about trying to goose the equity markets. They're never publicly going to state that they're trying to goose the equity markets. But and to your point, they may also be making sure that credit doesn't come to a complete stop. But let's not kid ourselves into thinking that credit has been flowing. It has been stalled ever since they started this aggressive rate hiking campaign.
No, and I think they realize that, and I think that's kind of part of the idea that, look, they had to provide support here to hedge a real crisis happening, but you can kind of anticipate when credit has tightened up this much that regional banks are going to fail, that they're going to have major problems. You just got to keep that from being a systemic risk.
But I think that's the problem. I think that's the problem, though. You can say that they should have seen this coming, and obviously banks are, most of these banks are public companies, and you can in fact see it coming because it's right there in their 8Ks and their Qs. But they didn't see it coming. That's the point, right? They did not see it coming. There was no indication from Powell's speech 2 days before Silvergate and Silicon Valley and Signature and Credit Suisse failed that there was any sort of pain coming at the banking level. This did catch them by surprise. And again, I think that points to the credibility issue.
Yeah, I mean, it's fair. Like, obviously, credibility is a up to each own's interpretation. I mean, you could come on the other side and say if they were pointing out issues at the banking sector, you're doing the same thing as a lot of people were on Twitter last week, which is kind of just facilitating it.
Sure. Well, let's go. Let's go to the actual numbers, right? I mean, because we're in 2008. You had TARP. It was probably way too late by the time they instituted TARP, which is why things got as bad as it did. Whereas this time, governments around the world, central banks were very quick to act, very quick to put in those swap lines. But I think you wrote in the piece that there was about 165 billion that was already withdrawn from the new bank term funding program. And what does that mean in terms of the balance sheets here? We spent a year now of tightening, like the Fed and other central banks trying to finally wither down the balance sheet that had been growing for 12 years. And they gave back half of that in a week by just opening this program. Is that right?
Yeah, pretty close, like 40%.
So with that backdrop, regardless of what they do with rates tomorrow, regardless of what they say, why would the market not just focus on that number? That even, every time central banks try to be the bad guy and they try to withdraw liquidity and they try to decrease the balance sheet, something breaks and they come to the rescue again. We saw it in 2019 when the repo market broke, and now we're seeing it again.
Yeah, I mean, it's just a question of whether the amount of stimulus coming from the public sector can overcome the contraction coming from the private sector, right? If real growth is slowing fast enough and the government's or the Fed is not comfortable putting money in that fast, then that's where you start getting impacts to financial markets. But I agree with you. I mean, that is definitely a big liquidity injection, and then plus swap lines that haven't been established or that have only been in the most critical events of the last 15 years. Like, certainly they're not taking this lightly by any means. It's not QE. Like, this is not intentional stimulation of the economy. This is more like we're taping the pieces of the financial sector together with duct tape to make sure that it holds on a little bit longer. But yeah, it is certainly a major move from them.
Okay, so Bitcoin been a huge beneficiary of this. Obviously, one, I think Bitcoin's has a double whammy of positive factors right now. The first, of course, is that it is a bearer asset, and people are terrified right now of their banks and of stable coins and everything else. So any bearer asset is going to benefit, and Bitcoin being certainly one of the biggest and most well known. But then you also have this increase in global liquidity, and I think you and Arthur Hayes have probably been louder than anyone talking about how Bitcoin doesn't really track gold, it doesn't really track equities, it really just tracks global liquidity. Is that what we're seeing right now? Is that this increase in regardless of how you want to measure it, right? Some measurement of global liquidity has increased, and as a result, Bitcoin's tracking.
That's absolutely right. Yeah, I think a lot of the kind of macro analysts have converged onto a couple specific measures of global liquidity, and it's easy as when the Fed balance sheet goes up $300 billion in a week, global liquidity rises, and so you definitely have if anybody's tracking that for their Bitcoin exposures, that is definitely what's contributing here.
Yeah. So and as a result, you saw a lot of hedge funds get carried out in the last 10 days, right? Because any momentum indicators were going the exact opposite way, right? Up until the banks started failing, you had rates rising, you had tech stocks falling, crypto falling, value stocks higher, and then immediate about face, and you saw you went the other way, where tech stocks and crypto started going higher, treasuries started rallying, and of course, bank stocks getting killed, and pretty big move there the other way, and a lot of funds got caught off guard. And I think the volatility we're continuing to see. I think the volatility we're continuing to see in rates is because of that, right? There's a lot of closing down of positions, both short and long, that are happening right now, contributing to a lot of volatility in the rates market.
Yeah. I mean, it's definitely the primary driver there was being short on the short end of the curve. that was kind of one of the strongest trends in the market. And 12 standard deviation move or whatever it was last week on the other way will certainly do that to CTAs who are levered up going one direction.
For sure. All right, let's change gears a little bit here to another type of helicopter money, airdrops. So everyone's talking about it. Everyone seems to have an opinion on it. What say you with regard to Arbitrum?
Yeah, I think the biggest thing here is just how big of an airdrop this is likely going to be. I've got a chart here kind of showing a couple of comps that are within the sector. So for context, Arbitrum is a Ethereum layer 2 rollup. So essentially a scalability layer on top of Ethereum where you can transact more cheaply and more quickly than you can on mainnet. There's a couple others in that area. Matic, Polygon is one, and Optimism another, and they're both surprisingly valued very, very similarly in terms of their fully diluted valuation. Arbitrum actually has a lot of users relative to these other projects. A lot of all the fundamentals are really strong, and they're distributing this pretty widely. Even the size of the airdrop in terms of percentage of the token is higher, much higher than Optimism's. So just doing some basic comp analysis here, I think you could see something like $1.5 billion of tokens airdropped, which would, I'm pretty sure, be the largest airdrop ever, at least at the time it got dropped.
I mean, obviously, we've seen this a lot now. We've seen airdrops as sort of the biggest form of distributing a token, especially in the US, since all of their channels have been basically shut down. The success of airdrops has been mixed and really pretty negative more recently, right? These airdrops, basically you get a little bit of a fervor on the first day or two of trading, and everyone wants to own the new token and they buy it. And then all these tokens that were airdropped immediately get sold, and the token tanks over the next 3 to 6 months. Eventually it gets washed out, and then you maybe see a renaissance later. We've seen that over and over again. Do you expect something similar here with Arbitrum, or what's your expectation with regard to how this actually trades?
Yeah, I think that makes sense. I really think that there should be a decent premium, and I think the market is pretty in consensus that Arbitrum should be at a decent premium to these other tokens. So I would not be at all surprised to see this trade 50% above where these are, talking about like $1.70 to $2 even on the price. It sounds like there's a lot of buyers on kind of the lower end of that are willing to support it. Certainly you could see the common airdrop dynamics as well, that usually this gets sold into by the people who are getting the drop and just want to monetize that. I do think there are some positives here going forward, though. There's a big Ethereum upgrade, proto dank sharding, that will be a huge benefit to layer 2s coming later this summer, which, yeah, I think that you've really seen the market start to respond more and more to these Ethereum upgrade cycles to create narratives, the liquid staking derivatives being one that was recently occurring as a result of the withdrawals, the Shanghai upgrade coming up. So I really could see that these layer 2 tokens doing well over the more medium term.
Yeah, so it's interesting that you wrote basically about the banking stimulus, or the central bank stimulus, as well as the Arbitrum airdrop, because you're right. At a 10,000 kind of foot view, it's very similar, right? They're both stimulus, but very different. In fact, I want to read exactly what you wrote verbatim to close out the blog that you wrote, because it's really powerful. You wrote, while it's obviously an apples to oranges comparison, it's striking to observe the week's events together. In one world, we had a bank failure requiring emergency action from the government without shareholders' approval. In another, a project distributed governance rights to hundreds of thousands, where all token holder decisions will immediately and automatically be executed by smart contract after a vote, and where users could gain access to the distribution for fees numbering in the cents. In one world, we watched in amazement as the central bank offered larger and larger credit lines to an ailing bank, wondering what could have created such a big hole. In the other, every single transaction that led to the governance distribution was posted to a globally accessible public ledger and able to be checked for people trying to cheat the system. The differences in transparency and fairness between these two worlds should be readily apparent. I think that might be the best paragraph you've ever written. It's very, very important for people to understand the differences that these two worlds are creating right now, right? what tokens are doing in terms of transparency, in terms of on-chain voting, and it's not perfect, but where it's trying to get to is just so much more fair and equal and transparent than what we have seen in this opaque, quasi government sponsored equity and debt market. Go a little more detail. I mean, what, like I said, I think it was the best thing you ever wrote, but what else are you thinking when you are comparing these two?
Yeah, I mean, I think it's a story of like just what the base infrastructure layer is like, right? Obviously, in DeFi right now, we don't have the application layer, the actual rails that you have in the current financial system that are able to move money around like they do in the banking system and how it works now. But what's being built is just kind of, I think, a better base layer, which is kind of what I'm getting at the end here. Just having a public ledger, even if there is private transactions in the future on the blockchain, you can still have everything be for sure valid. Nobody's cheating the system because it's all being verified in the public. You can have this fairness because you can have like identity tied to various addresses. You can have users being participating in governance as well, to a large extent, more than you can have in the current system, where it's with shareholders who are really kind of just capital holders. And yeah, I do just think that probably leads to a more equitable distribution as well.
Yeah, well, I 100% agree with you. I thought very well written this week, Nick. Appreciate you coming on. I think we'll end there. We'll be back again next week, folks. But how you guys can get a hold of Nick anytime on Twitter at Nick_Hotz, HOTZ. And obviously, you can find all this material on our website at ar.ca/blog. Appreciate the time, everybody. That's our two Satoshis, and we'll see what happens this week.
Thanks, Jeff.